Today's topic is a cornerstone of investing: mutual funds. In this video, we'll look at different types of mutual funds and how they are priced. So, if you're looking to expand your investment knowledge or just refresh what you already know, this is the video for you. What exactly is a mutual fund? Well, at its most basic level, a mutual fund is a type of investment vehicle. But it's not just any vehicle. Think of it as a kind of financial carpool, where multiple investors pool their money together. This pool of funds is then managed by investment professionals who invest this money into a variety of securities like stocks, bonds, and other assets. The great thing about mutual funds is that they provide an opportunity for small or individual investors to access diversified, professionally managed portfolios. By diversified, we mean the fund is spread across a wide range of investments. The advantage here is that this diversification reduces the risk that comes from investing all your money into a single stock or bond. When you invest in a mutual fund, you are buying shares or units of the mutual fund and become a shareholder or unit holder. As a shareholder, you participate proportionally in the fund's gains or losses. Each share or unit represents an investor's part ownership in the fund and the income it generates. Let's break this down with an example. Let's say you have a mutual fund that invests in the stock of 10 different companies. If you invest in that mutual fund, you are essentially investing in all 10 of those companies at once, which reduces the risk compared to investing in a single company. If one of the companies doesn't do well, the strong performance of the other companies can help balance out the loss. Let's discuss the different types of mutual funds that exist. The first type of mutual fund we're going to talk about is an open-end fund. Open-end mutual funds are the most common type of mutual fund. They don't have a fixed number of shares. Instead, the fund issues new shares or redeems existing shares as investors come and go. The price at which these shares are issued or redeemed is determined by the net asset value, or NAV, which is calculated at the end of each trading day. Unlike open-end funds, closed-end funds have a fixed number of shares that are issued to the public through an initial public offering. Once these shares are issued, they are traded on an exchange, just like individual stocks. The price of a closed-end fund's shares can fluctuate above or below its net asset value based on supply and demand factors. The third type is the Unit Investment Trust, or UIT for short. UITs also issue a fixed number of shares to investors, but these shares are called units, and the investors in UITs are called unit holders. Unlike other types of mutual funds, UITs have a defined termination date, at which point the investment vehicles within the UIT are sold and the proceeds are paid out to the unit holders. The fourth type of mutual fund we'll talk about is money market funds. These funds invest in short-term, high-quality investments issued by U.S. corporations and federal, state and local governments. They are one of the safest investments and provide a modest return. There are a lot more specialized types of mutual funds, such as sector funds, which focus on a specific industry sector, and balanced funds, which invest in a balanced mix of stocks and bonds. Each type of mutual fund has its own set of benefits, risks, and considerations, so it's important to choose one that aligns with your financial goals. When it comes to mutual funds, pricing might seem a bit mysterious, but it's actually a straightforward process. Mutual fund shares are priced based on their net asset value, or NAV for short. Now, you might be wondering what this NAV is. The NAV of a mutual fund is calculated by taking the total value of the assets in the fund, subtracting the liabilities, and dividing it by the total number of outstanding shares. This calculation is performed at the end of each trading day. Let's break down the NAV calculation a little more. Say a mutual fund has $100 million in assets and $10 million in liabilities. Subtracting the liabilities from the assets gives us $90 million. Now, if there are 3 million shares of this mutual fund outstanding, we would calculate the NAV by dividing $90 million by 3 million, giving us a NAV of $30 per share. Here's where it gets interesting. When you buy or sell shares of a mutual fund, you do so based on the next NAV calculation. This is why mutual fund orders are processed at the end of the trading day once the NAV has been determined. For example, if you place an order to buy mutual fund shares at 10 a.m., your transaction won't be processed until after the market closes, and the NAV for that day has been calculated. Remember that the NAV of a mutual fund fluctuates daily. As the value of the securities in the fund rises and falls, so does the fund's NAV. These fluctuations reflect the changing value of the underlying portfolio and determine the price you pay when buying shares or the amount you receive when selling. Now, we're going to explore the key differences between two popular investment vehicles: mutual funds and ETFs, or exchange-traded funds. Both mutual funds and ETFs are types of investment funds, which pool money from various investors to purchase a diversified portfolio of securities. However, the way they are bought, sold, and managed can be quite different. So let's dive into these differences. One of the main differences lies in how these funds are traded. Mutual funds are bought and sold at the end of the trading day at their net asset value, or NAV, which is calculated after market close. On the other hand, ETFs can be bought and sold throughout the day on a stock exchange, just like individual stocks. Their prices fluctuate based on supply and demand during trading hours. Another key difference to consider is the minimum investment requirements. Some mutual funds may require a minimum initial investment which can range from a few hundred to several $1,000s. ETFs, however, can be bought for the price of a single share, which could be significantly less and thus more accessible for beginner investors. In terms of management styles, both mutual funds and ETFs can be either actively or passively managed. However, ETFs are most commonly associated with passive management and tracking an index, while mutual funds are often actively managed with the aim to beat market performance. Expense ratios and tax efficiency are also important to consider. Generally, ETFs tend to have lower expense ratios than mutual funds. And due to the unique structure of ETFs, they can also be more tax efficient compared to mutual funds. Mutual funds can be a great tool for diversifying your investment portfolio and accessing professional management. However, like all investments, they come with their own set of risks and considerations, so make sure you fully understand a fund before investing. That's all for today, folks. We hope this video has shed some light on the different types of mutual funds and how they're priced. Don't forget to like this video, share it with your friends, and hit that subscribe button for more finance and investing wisdom.